Welcome back, everyone, to a seriously timely explainer. Look, if you've been watching the energy commodities market around this July 30th, 2026 timeframe, you know we are in the middle of an absolute tug of war. We're seeing a really fierce head-to-head battle between these massive global news headlines and the raw physical market data on the ground. It's a totally fascinating conflict. So today, we're going to break down exactly what is driving these massive swings. Let's get right into it. Here is our roadmap for today. First, we'll look at the real supply-demand tug of war. Then we'll dive into crude oil's bull trap. After that, we'll check on natural gas, which is acting like a hibernating bear right now, before hitting the massive supply shock in refined products. And finally, we'll wrap it all up with some concrete trading recommendations. All right, part one, the real supply-demand tug of war. So on one side of this market, you've got this geopolitical risk premium, and it is pulling prices up hard. Why? Well, recent U.S. airstrikes targeting Iran-linked groups instantly revived all these fears that supply routes through the Strait of Hormuz could be disrupted. And as we know, fear drives prices higher. But pulling back in the exact opposite direction is the real supply and demand. The physical reality on the ground is that we actually have an oversupply of a lot of these raw commodities, which fundamentally pressures prices downward. And that right there is the grand tug of war defining the entire market today. Moving on to part two, crude oil and the classic bull trap. Now, crude oil is incredibly sensitive to geopolitical news. We saw WTI, the U.S. benchmark, push up really strongly toward 84.20, cresting just above 84.60. Meanwhile, Brent crude surged up, touched 87.70, and then essentially collapsed right before it could break that major psychological barrier of $90 a barrel. I mean, on the surface, it looks like a powerful rally, right? But looks can be super deceiving. Enter the bull trap. The current technical structure is basically screaming that this price spike is a temporary mirage. It's just market doping from the conflict news. It creates this short-term rush, tricking optimistic buyers into entering the market. But behind the scenes, the really large investors are using these brief, news-driven surges to lock in their profits, sell off, and exit their positions. So how do we actually trade this? Well, the data shows the smart money is actively selling this rally. Tactically, you're going to want to look for short positions when the price hits those resistance levels. Now, the only exception, the one thing that would totally invalidate this strategy, is a complete, total blockade of Middle Eastern shipping lanes. Short of that extreme event, this rally is a trap, plain and simple. Okay, section 3, natural gas, our hibernating bear. Negative 44.45%. Let that number sink in for a second. While crude oil is jumping at literally every single geopolitical headline, natural gas has plummeted nearly 45% from its peak earlier this year. It's currently trading at a dismal $2.73 per MMBTU. It is essentially acting like a hibernating bear, just completely asleep to the geopolitical risks of the world. You can see it's locked in this prolonged, really heavy bearish trend. Natural gas just does not care about tensions in the Middle East right now. It has totally decoupled from crude oil's panic. And you might be wondering why. Well, because the physical market reality is just way too heavy to lift. The absolute core issue strangling prices here is a massive supply-demand imbalance. Yes, it's the middle of summer, and air conditioners across the country are running on maximum overdrive, but it simply doesn't matter. Production and current inventories are so massive, they effortlessly crush that summer cooling demand. We are currently sitting on stockpiles well above the 5-year historical average for this time of year. There's just too much gas out there, and that completely destroys any momentum for a price increase. Section 4, let's talk about refined products and a major supply shock. This is pretty incredible, plus 108%. That is the dramatic year-to-date surge we've seen in RBOB gasoline. Prices have been hovering right near historical highs, around $3.20 per gallon. Now sure, we've seen a slight cooling off recently, which is mostly due to that same profit-taking we saw in crude oil as Middle East tensions took a quick breather, but the overall upward trajectory this year, it has been absolutely massive. But hey, if you thought gasoline was wild, check out heating oil, plus 265% since the beginning of the year. That is a staggering rally. Prices recently hit around $4.18 per gallon, which, by the way, is up more than 48% just from last month alone. Honestly, this is the absolute standout metric of this entire explainer. So what's happening? We are witnessing a really severe disconnect in the market right now. It's essentially a massive phase mismatch. On one hand, global supply of the raw, unrefined crude is sufficient. We have enough of the raw stuff. But on the other hand, we have critical shortages of the actual processed products that everyday consumers need, like gasoline and heating oil. So what is actually causing this supply shock? It really comes down to 3 structural factors. First, the ongoing impacts of Ukrainian UAV attacks on Russian oil refineries are still causing severe lingering damage, which is forcing Russia to heavily restrict its exports of diesel and gasoline. Second, our domestic U.S. inventories of these refined products are sitting way below their 5-year averages. And finally, because of this super tight supply of refined goods versus plenty of raw crude, the crack spread, which is the profit margin refiners make for turning that crude into usable products, remains extremely attractive. It is a textbook supply squeeze. All right, section 5, let's pull all this together into some actual trading recommendations. Here is the strategic posture based on everything we've just covered. Step 1. For natural gas, absolutely do not try to catch a falling knife. The physical oversupply is just too massive. Any short-term bounces you see, those are just temporary technical corrections, not a true trend reversal. Stick with that primary downward trend. Step 2. For crude oil, remember the bull trap. Unless a total Middle East blockade happens, use those technical bounces driven by the news cycle to take short positions. And step 3, for refined products, the supply is incredibly vulnerable right now. If you're looking to buy, you need to exercise some serious patience. Wait for deeper market pullbacks to secure a much better position, rather than trying to buy at the very top of a 265% rally. I want to leave you with this final thought today. Markets never sit still, right? The next catalyst is literally always just around the corner. To truly understand who is going to win this ongoing tug of war between geopolitical fear and actual physical supply, you need to keep your eyes on two massive upcoming data points. We have Saturday morning's Baker Hughes rig count and next week's highly anticipated OPEC Plus meeting. Will these events confirm the oversupply or will they shock the market with new restrictions? That is exactly what you need to watch. Thanks for joining me on this explainer. Keep learning, and I'll catch you all next time.